Imagine waking up tomorrow and realizing 90% of your net worth gone. Suddenly, every company you invested in is worthless. You realize all the people building the hype and telling you to buy already sold, leaving you with nothing. This is exactly what happened in the year 2000, the so-called dot-com bubble, where in just 2 years, $5 trillion vanished. And it may be happening again today. Why did this happen, and how can you avoid being the victim when history repeats itself? Let me explain. I'll split this video in 3 parts so it's easier for you to understand. Let's begin with part 1.
The Internet.
Back in the late 80s, using the internet was complicated. You had to type commands and deal with lots of text. All until our homie Tim changed all of that by creating the World Wide Web, which made the internet visual and clickable, so normal people could actually use it. After that, browsers like Netscape Navigator showed up, and that's when things exploded. Here is a cool graph. The internet was starting to grow so naturally, people were looking for ways to profit out of it. Which brings us to part 2.
The Startup Gold Rush.
Faster internet systems made email, messaging, and online shopping possible, and combined with low interest rates, at the time it led to thousands of online startups being created. Investors pushed internet startups to grow fast instead of making money. They stopped caring about profits and started caring about clicks. If a website had lots of users, it was seen as a success. Companies spent money like crazy, with fancy offices, trips, and massive dot-com parties. I don't think you have to be a genius to tell me if there is something wrong with a company that doesn't make money, doesn't have a solid business model, and is somehow worth hundreds of millions just because it burns cash on marketing instead of building something real. We'll go over some examples, like Pets.com in the next part. As the bubble got closer to its peak, investing stopped being something only professionals did. Day trading became popular, and stories of people quitting their jobs to trade tech stocks were everywhere. The media made this behavior feel normal. Channels like CNBC covered the stock market with the same excitement as sports. Magazines even said old rules like profit and price-to-earnings ratios didn't matter anymore in this so-called new economy. Work culture also changed. Offices became more casual, employees were often paid partly in stock options, which made many feel rich on paper overnight, but most couldn't actually sell their shares because IPOs, basically when a company goes public, usually came with a 180-day lockup period for founders and early investors, which played a big role later on, as we'll see in part 3. Soon, everyone was talking about stocks, even people with nothing to do with finance, which is usually a sign something is about to go terribly wrong.
The Crash.
So what do you think happens to risky startups when interest rates rise? And what about when insiders can finally sell their shares after the 180-day lockup? Many sell at the same time, flooding the market and sending prices crashing sometimes by a third in just 6 months. Remember Pets.com. In its first year, Pets.com made only $619,000, but spent $11.8 million on advertising. $11.8 million on this. Shipping heavy, low-profit items like pet food and cat litter cost too much, and the company lost money on almost every sale. In their February 2000 IPO, Pets.com raised $82.5 million, and just 9 months later, their stock went from $11 all the way down to 19 cents, wiping out the company. Not all companies went bust. Amazon survived and later became a giant. They raised $672 million in bonds just before the crash, which kept it alive even when its stock fell from $107 to only $7. Jeff Bezos was also positioned for the long game. While most dot-coms needed quick profits, he was willing to wait 7 years to make money. In the end, the dot-com crash led to around $5 trillion being evaporated. It's not that the internet wasn't a huge innovation, the market just expected it to expand way too fast. So, what's the takeaway? When even your hairdresser is telling you what stocks to buy, it might be time to slow down, do your homework, and not chase the hype. I hope this was insightful. Leave me a comment if I should improve something. Till next week.